So I'm here to introduce our first panel. This panel will focus on short-term risks affecting the condition of agriculture lenders. The session will be moderated by John Anderlich, Assistant Director for the FDIC's Division of Insurance and Research. And panelists include representatives from various types of agricultural lenders, as well as the academic community. We have a researcher who has studied the agriculture industry and farm lending extensively. So John, I'll turn it over to you and your panel.
I couldn't be happier with the panel we've been able to put together this morning. We're here to talk about the near-term risks to agriculture, looking out maybe the next year or two. And as you know, we're in the middle of definitely some issues: lower net farm incomes, lower commodity prices. What we have for you today is 3 agricultural lenders and a leading agricultural economist to talk through these issues. We have 90 minutes for this session. I have a series of questions that I'm going to throw to the panel and hopefully generate a good discussion. But to keep this as interactive as possible, I'm going to take questions from the audience throughout. So if you have a question, raise your hand. One of the microphone people will come over to you, and when we have a logical break in the conversation, then we'll take your questions. And just to keep the flow going, we'll keep questions to 1 or 2 at a time, then we'll go back to the moderated session. I decided that instead of reading a giant bio for everybody, that I'd let them basically introduce themselves. First on my left is Owen Bolte, the President and CEO of United Bank of Iowa. His bank is one of the 1,300 plus farm banks you just saw on the map that Jim put up. And his bank is the largest farm bank headquartered in Iowa. Owen, why don't you tell us a bit about yourself and your bank?
Thanks, John. My name, again, is Owen Bolte. I'm President and CEO of United Bank of Iowa. United Bank of Iowa is a product of the 1980s. We were a 2-bank office in the 1980s. And in fact, I think maybe our board of directors had a meeting in Kansas City during that time. But we emerged from the 80s with 2 offices and began a growth pattern and a commitment to agriculture. Today we are in 31 communities in 16 counties in rural west central Iowa. We have around $930 million of agricultural loans. Approximately $540 million of that is in ag or farmland, the balance being in operating and other types of ag lending. We're a little unique in that our headquarters is in Ida Grove. I don't know if many of you know where Ida Grove is, but it's the home of Shorelander boat trailers and Gomeco, those big yellow machines you see that pave roads. So we have 2 leading manufacturers in Ida Grove, but we're only about 2,100 people. So I think we're unique in that we're trying to operate a $1.6 billion financial institution in Iowa from a community of $1.6 billion. To put a little bit we don't celebrate a lot in Ida Grove, but this week we celebrated having a new Verizon tower. You know, I used to sit in my office and go, why can't I get a Verizon signal? You know, so, but this week we got a new tower, a new Verizon tower on our water tower. So we actually have a Verizon signal for, if there's any examiners here that have been there, that's been their frustration as well. So you go out on the sidewalk to make a phone call. So that's a little bit about us. First time I've ever been on a panel like this, so I hope I have some things to add. Again, we're committed to agriculture. We think we're good at it. I tell people that the difference between being good and average is about 18 months. You know, so that's where we're at.
Owen, thanks. Our next panelist is Dr. Alan Featherstone, Professor, Department Head, and Director of the Masters of Agribusiness Program at Kansas State University. Dr. Featherstone, tell us a little bit about yourself and your work.
Yeah, my name is Alan Featherstone. I originally grew up in Wisconsin on a dairy farm. Went to Wisconsin River Falls for my undergraduate degree and then Purdue University for my master's and PhD. And then I came to Kansas State in 1986 and have been here ever since. Had some opportunities to leave, but fortunately the university made it worth my while to stay. A little bit about the department in terms of we have about 430 undergraduate majors. We have about 70 individuals in our master's and PhD program on campus. And then we have a distance master's program that's online where we have about 100 individuals in those programs. The market for undergraduates and graduate students remains extremely strong, probably a little bit different than the previous downturn in terms of we're running roughly 98% of our students within 6 months of graduation either being employed or going on to professional school. Starting salaries right at $49,000, and that's been going up about $1,000 a year. And so the industry is very exciting, and I think there's a lot of opportunities ahead. So we'll end there.
All right, thank you. Our third panelist is Ken Keegan, and Ken's a veteran of these. You were on our 2011 symposium, which I appreciate. He's the Executive Vice President of Farm Credit Services of America in Omaha, Nebraska. Ken, why don't you tell us a little bit about yourself?
Thanks, John. When someone calls you a veteran of something, that means you've been around a while, so that's probably the truth. But I've enjoyed the interaction and relationship we've had with both you and Rich. I also grew up on a small family farm, actually east of Cincinnati, Ohio, and we had a cow-calf operation and raised tobacco. So more years than I like to admit now, that was where I got my entry into agriculture. Worked for Farm Credit Services of Mid-America at that time, which was based in Louisville, Kentucky, so you probably still hear a little bit of that southern drawl from me. But in '97, got the opportunity to come to Farm Credit Services of America, located in Omaha, Nebraska. And kind of a funny story, I'd never been to this part of the country. Really didn't know what to expect, but I can tell you if you're from there, the image of Omaha, Nebraska was not all that positive. And I remember telling the individual that was recruiting me that there's no way in hell I'll ever come to Omaha, Nebraska. And I got to tell you, it's been the best 20-some years of my life and my family's life. It's a wonderful place, not unlike Kansas City, a lot to do in the city, but also really the heartbeat of agriculture. So for me, it's been a great place. The companies that I'm affiliated with are really two associations, and I think many know the Farm Credit System is made up of about 73 entities. Some of those are funding banks. The majority are lending associations like ours. So we're one of 69 associations across the country. We happen to be the largest of those, and they range in size quite a bit as you look at the makeup of the Farm Credit System. But we also jointly manage and lead Frontier Farm Credit, which covers the eastern third of Kansas. And most of my comments are going to be about the combined operations, because I think as you go into any of our operations, whether it's in Frontier or FCS America, you'll find very similar culture, very similar way of doing business, products, systems, all of that. Part of the reason we did the alliance in 2015 was to capture the advantage of the combined operations. So a little bit about the companies. We're about $32 billion in loan assets, about 1,700 employees. FCS America covers 4 states of Iowa, South Dakota, Nebraska, and Wyoming. And as I mentioned, Frontier is the eastern third of Kansas. We have about 48 offices in that territory. And probably the most interesting thing is really the makeup of our portfolio. We've done a lot to continually try to find diversity. No surprise, if you're in the middle of the country, you're going to have a lot of grain production in your portfolio. And so our largest concentration is in grains, about 40%. Then the beef industry, we have about 9% of our volume in beef feedlots, about 7% cow-calf, 9% swine, 4% dairy, and then 20% in other. And those are largely going to be shared credits, probably with some of your institutions across the country in large agribusiness types of credits. So look forward to the opportunity to engage in your questions. And Rich, thanks for telling us no PowerPoints. That was the best news I heard when you set this up. So look forward to your questions.
All right, Ken, thanks. And our fourth panelist today is Joel Van Vark, who is the Vice President of Credit at John Deere Financial in Johnston, Iowa. Joel, why don't you tell us a little bit about it?
Good morning. Thanks for inviting me. I'm also a first-time panelist, so I'll give you a little context, first of all, about John Deere Financial's role So we're a captive to Deere and Company. Our mission is to help support the sale of Deere equipment. So we have agricultural and turf equipment, construction and forestry equipment. We provide those services to anywhere John Deere products are sold. So we have distribution in about 100 countries around the world. We have a finance presence, a financial services offering in 53 of those countries, and then offer through vendor agreements or other type of financial support in the rest of those locations. In the U.S. and Canada, my responsibilities are for credit, and we describe that as providing credit first to our dealers, so those who sell John Deere products, and then secondly to customers, those who buy John Deere products. In the U.S. and Canada, we also have a revolving product. That revolving product is used for agribusiness inputs predominantly, typically seed, some feed and chemical. Just sizing, John Deere Financial, we have a portfolio of about $40 billion. We have about 2,300 employees, and our headquarters is in Johnston, Iowa.
All right. Well, let's turn to the discussion questions, get the show on the road. We'll begin the panel with a discussion of farm profitability. Dr. Featherstone, I'll pose these questions to you first, and then the lenders can add their thoughts. When people hear today's farm income is half what it was in 2013 and is among the lowest in the last 25 years, many wonder whether any farmers are profitable. Can you share your observations and shed some light on industry profitability? Are there still farmers out there making money? And for those farmers who are faring the most poorly, how are they doing in a historical context?
Yeah, we can certainly look at that. In terms of 2018, and I just have our 2018 numbers finalized about 2 weeks ago. 2018 actually ended up being a pretty profitable year within farms in Kansas. In terms of, to give you a little bit of a history, in terms of in 2014 incomes on average were over 100,000, about 120,000. That then dropped to about 6,000 in the next year. Then we went to about 35,000, then 67,000 in 2017. And this last year, we were right at 100,000 in terms of profitability. And so in some respects, the sector has recovered over the last year. I also have a chance to look at some Illinois numbers, and Illinois also had a reasonably well 2018. A lot of the concern out there, though, is where the money's coming from. In terms of if you look at the profitability without the MFP payments, the profitability would have been 63,000. And so of that income, roughly 37% was from the market facilitation payments, and certainly going into the year before the world changed maybe about a month ago, in terms of there was a lot of concern in terms of what 2019 would look like if those payments were not continued. But of those, to give a little bit of a number in terms of how important there were, roughly 92% of Kansas farmers received some market facilitation payment. And if you look a little bit more, essentially 88% received more than $2,500. And so for a lot of farmers, that provided substantial liquidity to essentially help them begin to make some of their decisions. But even without that, throughout the system, or throughout, roughly 40% of the farms over the last 5 years had profit in each year. And so their net farm income was profitable or above zero for essentially the last 5 years. Previous to this year, essentially, if you would look at the previous 4 years, 2014 to 2017, there were roughly 20% of the farmers in Kansas that lost money each year. And so they had negative income, negative income, negative income, negative income. When you add on the better year in 2018, essentially that number dropped to 10%. And so roughly 10% of the farmers have lost income in each of the last 5 years. Roughly 40% have made income in each of the last 5 years. And then you have the remainder that have bounced around. with the income, and distributions are important in the sector. If you look at the distribution, even with 100,000 in net farm income, there were still about 19% of the farms in 2018 that ended up having a negative net farm income. And so the distribution is really important out there. And there is a segment that are struggling in terms of the concerns about mental health and farmers in over their heads from a debt perspective. Those are real. But again, it is a small segment out there, but it is real. And we'll stop there and turn it back, and maybe we can get into a discussion here instead of a monologue.
No, sure, I appreciate that. That's exactly what I wanted. Lenders, what are your thoughts? What's going on in your markets? Are you seeing this barbell, like Dr. Featherstone just mentioned, that you have maybe 40% doing well, and then a tail at the other end that's been struggling for 5 years?
So I'll weigh in first. So we have about 60,000 producers across the 4 1/3 states we serve. So as we get through a renewal season, we do a pretty deep dive into looking at the information that we've collected on those producers. The best information, this is really focused on the grain segment, which had probably the bigger stressors. We had about 72% that we validated made money, which was a pleasant surprise. I think we came in expecting that number to be lower. And then a significant portion of the remainder were at or near break even. So again, probably aligned pretty closely with your comments, Dr. Featherstone. But it takes a combination of production, a lot of bushels. If you remember in 18, we generally had really strong production, so we had a lot of bushels to market. And then the MFP payments made a big difference. So many at least are sitting in to this point in time in fairly decent shape. They came in obviously with pretty solid balance sheets. And I would say over the last really 5 years now, we've done a lot with our producers to talk about adjustments that they need to be thinking about in their business and trying to understand, where are they making adjustments in cost of production and in other areas of their performance based on a long-term outlook, which is going to pressure them to have very efficient cost side of their business. So we've spent a lot of energy in that area.
Maybe I'll add to that if I may. So Dr. Featherstone, I think your data you recited was for Kansas specifically, and then yours was broader for the Midwest. So when I think about it from a national scale, I think it's still very consistent in terms of the kind of trends that we're seeing. We definitely have the same kind of proportion of customers that had net income and those that had net losses. And I would agree that the market facilitation payments were important.
Again, I'd agree with the percentages. I think that where the MFP program failed was it rewarded production. So we actually had a couple of counties where we had very wet areas, and so those folks weren't benefited as much. But the rest of our area probably enjoyed the best yields they'd ever had in terms of grain production. It was just fantastic. And so that was good. We do some analysis. We looked at cash flows on about 870 of our borrowers. There's some unusual things or neat things going on there, but average non-farm income in our farm units is about $60,000 to $65,000 a year. So most farm families have some source of non-farm income. Not all, but most do, and that's how they're benefiting. But of course, we have some credits that have some issues. I don't know whether it would be to that 20%. I think it's a smaller group than that. So last year, probably a poor year for some of our hog, not custom people, but those that owned hogs last year had some losses. Now that the good thing is that's come back, and I think there's opportunities this year for them if they're good at it to rebound. So.
And audience, remember, don't be shy. If you have a question, looks like we have a couple back here. No, wait for the microphone. The video won't pick you up. Thanks.
We focused on growers specifically. What about suppliers to those growers? How are they doing? Any ideas on that?
Well, particularly interested in our Main Street, whether that be a fertilizer or seed or implement dealers. I think the implement dealerships are probably the hardest hit by the current situation because, the largest group of our, I think the ag sector coming out of the 80s, they're survivalists in terms of their management. So the first thing they did was they cut back on their implement purchases. And I think that they're to be commended for that, but it's not good for Joel's folks, But I think the agronomy piece is real well. I mean, I think it's healthy, but I think the implement thing is little. I see some things going on. I watch UCC releases pretty quickly, so I kind of know when people are trading equipment that we have financed. And two things have happened. One is that slowed down. The other one is implement dealers never used to ask commercial banks to release liens. All of a sudden they are. So I've noticed that. So.
Yeah, I might add, I think the profitability that we talked about has had a positive impact on most of the supply chain, input supply chain. But the fact is, there's increasing pressure for needed adjustments in the cost side of the business, so they've had to deal with that reality too. We've seen some adjustments in cost overall, but it's been, I'll say, stubbornly, persistently slow. It's not been a big stair step down in terms of overall costs for our producers. So I would agree with you. I think they generally are healthy, and I think are also dealing, though, with the reality of adjustments in their business to match what they're seeing in their customer base.
Thank you. David Shim, State Executive Director for the Kansas Farm Service Agency. Kind of question for the panel is, do you see and Dr. Featherstone, you talked about the $100,000 net farm income, looking at farm management there. I mean, it seemed to me there was a wide variation across the state. We had as high as $180,000 in the southwest part. You go clear to the northeast, and it dropped clear down to around $57,000. When you factor in that aspect of an MFP payment, first one coming out, being based upon production, and then looking at my state there throughout the year, we had a significant drought that limited production, especially through the central and northeast part of that state. And then also when we start to look, I guess, a couple of questions I'd like to have the panel weigh on is one, how much regionalization do you see of this farm income? Do you think that is, or is this just affecting areas? And then what kind of concern do we have looking into the future, especially when we look at 37% of farm income last year was MFP, and then when you actually add in other program payments, it actually pushed that number clear up to almost half of farm income, if I remember right, between 50 and 55%, I think, was there. And so if I looked at areas that were clear down to 57,000, and I dropped their actual production net profit was clear down in 20 to 25,000, I guess that's concerns I have. So I'd be interested in comments from the panel.
No, I can begin looking at that. Certainly there is regional variation. Probably in terms of looking at the numbers, at least in the state of Kansas, some of the regions that have suffered previously actually had a good 2018, and so that was certainly a positive thing. And if you look at the numbers in terms of roughly the northern half of Kansas that did suffer through the drought, had the lower incomes, the southern part ended up doing much better. In terms of the MFP, certainly it is based on production, and certainly there are issues there. But I think it is important to realize that there's also the crop insurance program that most producers do take advantage of in some form or another. And again, with all insurance programs, you would much rather pay the premiums and never get the benefit from it, simply because we paid life insurance premiums on me last year, and I'm pleased with the result that we didn't get the indemnity. I don't know if my wife is or not, but certainly I am. But in terms of looking at that, there was a substantial amount of indemnities that those that did not have the yield ended up getting. And if you look at kind of the amount paid in versus amount paid out, the southern half, basically, they ended up were a net contributor to the insurance fund in terms of what they took out was nowhere close to what they paid in, even with the subsidization. The northern part did have higher crop insurance indemnification, and so in some respects, I think that's kind of what's going on. Certainly, I think there are issues in terms of you are exactly right that essentially more than 50% of the income was from the government in one form or another. That's never a healthy situation to be in terms of when we're after 2008, we never did those calculations in terms of what percentage of the income is the government. But over the last 5 years, they've been pretty important, and there were years where more than 100% of the income ended up coming from the government on certain farms. And I think that's where the uneasiness is, especially with the market facilitation payment going forward, is producers don't like uncertainty when they're investing in equipment, when they're investing in land. Those are long-term type investments, and so it's kind of hard to do with the short-term uncertainty, and so there certainly is a preference for seeing the markets move up, getting these trade distortions and trade agreements settled for a long-term decision-making. But I think in some respects, we're probably going to deal with uncertainty for a few more years as we go forward. In terms of if you look at worldwide production, it had been pretty high. And we had had a number of good production years globally, year after year after year, which led us into this supply-demand imbalance. And unfortunately, we may solve some of that this year within the U.S., which, again, you always would prefer your neighbor country to solve the imbalance as opposed to having to deal with it ourselves. But hopefully, farmers have been making good risk management decisions with regards to investment in some of the insurance products. It also seems like this year there is perhaps opportunity to price some grain. Again, there's going to be some risk there associated making sure you have the grain to deliver once you price it. But as opposed to last year, when we was looking at last year, one of the things that we heard a lot from producers was there just wasn't that profitable opportunity to price grain. Normally, the market would go up for a couple weeks, and so you could get some grain priced at good levels. But it seems like we're probably going to see some of that, and my guess is we're going to have more market volatility this year than we had last year, which does provide opportunities for those astute managers to make some of those decisions.
Well, so far the two questions have gotten to two of my sub-questions. So if we have any more questions, I'll take one or two more now because you're doing my job for me. Jim? I don't think you have to introduce yourself. You've done that already.
My question really goes back to the first question that John asked, and all of you talked about those borrowers who were not profitable last year, and it seems like all of you seem to think that number was in the 20 to 30% range. Ken, you mentioned in your comments briefly that you're working with your borrowers to sort of have them think about looking at the cost of their operations and sort of making sure they're right size, which is something we talk about here in the Kansas City region quite a bit. I'm just curious if any of you just sort of, as for the other panelists, if you could also, and Ken, if you want to add anything, but just sort of thoughts about that group, because we talk about, that's the group, of course, as bank regulators who are concerned about banks, the loan portfolios of the banks that we supervise. Those are the borrowers we focus on, just as I'm sure, and those are the borrowers you spend a lot of time thinking about at your bank. I'm just curious if anything you're doing to sort of encourage good risk management and good decision-making by those folks, and at what point you feel that's we're no longer able to work with someone because we don't see a path to profitability and a path to good results going forward. So any comments from any of the panelists, I'd appreciate it.
Well, I think in the process, which is, most banks, commercial banks, Farm Credit has an annual renewal type of a process. You always arrive at what the end result is, but in that, you're always drilling down to find out the cause. Lack of working capital is a symptom. It's not a cause. So it takes a real effort by lenders and customers then to figure out, or producers to figure out what the weaknesses are. Everyone, there's a commonality in the earnings equation for everyone, but they're all unique. And most people having some level of success have some strength in that earnings equation, whether it's paid for real estate, substantial non-farm income, a low power cost. The downside of that 13-year or that 2013 high prices was bonus depreciation, because a lot of folks, to avoid tax, obligated themselves to some machinery debt or building debt or whatever. So they're still living with that. So those kinds of things. But ultimately, I think that if you have a level of cooperation and commitment, agriculture is a great place to be because of, having been in the 80s. We have tools in place today that we didn't have then, that I think bring a level of stability. And if you can imagine, I tell people, this is a little bit like a snowstorm, and this is not a time to speed up. This is a time to tap the brakes, and most people have been. They've been tapping the brakes and slowing down and being cautious. And typically agriculture, it's a cyclical thing, will help grow itself out of it. Now, we had something in Iowa this week that was significant, I think. We had the Simply Best plant in Charles City announce their closing, which is a new chicken plant. And while it's not in our area, and perhaps we don't have a lot of exposure to it, I'm sure there's somebody that woke up on Monday or as soon as that news was, and they got concerned about how loans were going to get repaid or how the living was going to come or that type of thing. So those things are outside of our control. So.
Maybe I'd like to add, if I might, Jim, specifically, I think we might be unique in that for the majority of our business, for loans and leases, we're an indirect lender, so it's the dealer who originates that. And unless the credit gets to be sizable, we don't actually have much direct contact with the customer until we've already got the loan or lease on our books. So in terms of the counseling that you're talking about, we definitely are seeing more and doing more of that as the customer gets to be bigger. But I would say the dealer has definitely been engaging customers and talking about their investments in technology. And what we're seeing is not necessarily just a replacement of like for like equipment, but investments in technology that are going to really help improve productivity. I think I should make one other comment as well. Comment was really addressed to Main Street and how are the implement dealers doing. And while I don't have specific data on the individual dealer, when I look across our entire channel of dealers in North America, actually they're quite strong. I think many of the dealers during the ag dealers I'm referring to in the 2012-13 period when there was the run-up in prices, they were very profitable. They sold a lot of equipment, and many of them built their equity during that period of time. And so just what we'd want the farmers to do, the dealers did the same thing.
Yeah, I might add a couple comments because it's an important topic, and over time we don't know yet whether this is a growing segment of our portfolio or not. But today, I think we continue to see most of our operators that are having some significant challenges, having multiple options to consider. So it's not like they come in and there's no discussion to be had, because they have options, largely because they have decades of accumulated equity in their balance sheets, and it gives them some options. But our approach has been to satisfy two key things. One, are they able to make the adjustments to be viable long-term? And then the second, and it's probably the most important, are they willing? And the willingness part is, are you willing to make some tough decisions about your business that may be necessary to put you in a viable long-term position? Things that help them have the appropriate levels of working capital on the top of their balance sheet to sustain some variation in the markets. And most importantly, do they have a cost structure that makes sense based on a long-term forecast of what commodities are going to be? And you know, they're not, our view is, 2019 may be an anomaly in terms of the spike we're going to see in grain commodities, but the long term probably hasn't changed a lot in terms of our outlook. So, probably the last piece for us, and, these are tough conversations, when we have a producer that clearly is either not willing or not able, but still has significant equity in their balance sheet, I don't think any of us up here are going to be interested in eroding that available and accumulated capital. That makes no sense, or equity in the balance sheet. So our point is usually if we have that kind of a disconnect, then we probably aren't a good partner for that producer going forward.
I think the other thing is there are, because of frankly the land markets and how well they've held up, there are options for individuals to maybe unwind some decisions they wish they wouldn't have made. And so to me, they are hard decisions, but I would totally agree with Ken that those that are willing to make those, I think they still have a lot of options. And this is much different than the 1980s, where land values fell 50% and all of a sudden there were a lot of farms that were upside down, and that's not the case. Certainly from a cash perspective in that, it's very tight, and there are a lot of individuals that are really struggling to do that working capital, but there are some hard decisions that can be made to help them through this cycle.
I'm Jay Bronger, and I work with the OCC. And Alan, you brought up the topic of land values, and so I think land values are very important to this whole equation. And I'm just curious what the panel is seeing locally in their markets with regard to land values. Are you seeing more sales that don't get completed if you have an auction situation, or it's a no-sale situation? Expectations aren't being met from an auction perspective. What are you seeing on the cash rent side? I think cash rents probably in this environment are still probably higher than are reflective of current commodity prices, and I'm just curious what you're seeing as a panel.
And by the way, I had 20 minutes set aside for this question, so feel free to take your time.
I'll talk real slow. Our land values are still strong, and there's good demand, and it's a supply and demand thing, and we don't have a lot coming to the market right now. While they're off the 2013 highs, average farm ground for most of our markets going for around $8,500 probably. Cash rents are another matter. I think they've backed up some. An interesting thing is we saw more cash rent movement in those stressed areas where they didn't get a crop last year. We saw ground given up this year and moved around. I don't anticipate we're going to see much this year, because I got to tell you, I'm going to knock on. We're in a garden spot in west central Iowa. We primarily have everything planted. It's up. We're hoping for a good growing season, and things will be fine. So I don't think rents will move much. Because I think that landlords will be reluctant to do that. Now, having said that, they're off the high. Ida County in particular was probably the highest in Iowa, of 330 average for high quality ground. At the peak, it's probably more like 260, 270 now, so it's come down. It's still, if you're selling corn for $310 or $320, it's still high. If you're selling corn for $4 or $410, then maybe it's still all right. So that's what we think. Long-term, based on USDA long-term projections, we feel there's strong support for farmland, that same $8,500 farm ground, to be in that $600 to $6,500 range. You know, that's what we think. So there's room to back up. Fortunately, I don't think any lenders financed at that level. So I don't think that's going to result in any losses to lenders. But if you have $5,000 financed against ground, it doesn't work very well. So.
Yeah, I maybe can add a few comments around what land values you're doing. I think Mr. Bolte's exactly right in terms of from 13, you know, on average, and particularly in Iowa and Nebraska, maybe 20% has come off of the values. We are forecasting, you know, whether it's forecasted or likely is probably debatable, but another 10% could easily come off of land values if we live in this margin environment that we think is the long-term picture. That's not going to be catastrophic. In fact, it probably is healthy. Cash rents have been a little slower, but we've seen some adjustments in overall cash rent levels as well. You know, I think the real story is just the numbers of transactions in the market are much fewer than we would have experienced, you know, 5, 6 years ago. So I think it's created still strong demand for the asset class, mostly producer buyers in the market, not a lot of outside investment coming in at this point. You know, if land values do adjust, you know, another 10%, will that create a return that makes it more attractive for some investor money to flow in? Possibly. As an institution, though, we do, like I think everyone that sits up here, we do the stress testing and we stress some pretty severe scenarios. We take it all the way down to a 65% decline in values, which is pretty significant. And it's not just about the impact on collateral. It's obviously around the scenario that would cause that event to occur, and what does that mean in terms of farmers' net income outlooks. And so we stress it based on forecasted net income down to the producer level. That won't be fun if that were to ever show up. We don't think that's a very likely scenario, but, well, you know, like all prudent institutions, you're planning for if that were to happen, we have a black swan that causes it. You know, are we going to be viable as an institution to serve the needs of agriculture?
I have a comment and a question. So at John Deere, we're not land lenders, so we're kind of on the sideline, but obviously affected the same way that the gentlemen are talking about. But I have a question in return. Have you seen a change in loan to value in terms of when you're financing land or the others that you're associated with are financing land? Have you seen a shift in loan to values?
Yeah, I would generally say I think ag lenders as a whole have been pretty disciplined in this space. And we implemented a thing we called sustainable lending levels, which were really based on long-term margin forecasts and capitalizing that back to what can be supported by the asset being purchased. Probably didn't slow down buyers' appetites to buy land. It just caused them to put more skin in the game. And when we first started that, it was during the peaks of the commodity price cycle. It wasn't fun. Even in our boardroom, they were struggling with, you know, kind of the euphoria of high commodity prices, and we were really disciplined about, we're not saying we won't finance purchases, we're just going to base it on long-term margin forecasts that we had put in place and worked with outside companies to help establish. Today, that looked like probably the best thing we could have done, but it's not just farm credit. I think our banking cohorts in the community banks and regional bank space were also very disciplined, and I think that's a bright spot for where we're at today in terms of the ability for agriculture to withstand some of the shock of the cycle.
One part of the question was asked in terms of the transaction levels. We have the ability with a partnership with the state of Kansas to track the number of sales, and 2017 was the trough in terms of the number of sales. We have seen a bit more sales activity, completed sales and transfers in 2018. We're nowhere near the level in 2013 and 14, but within the numbers that we've seen within Kansas, there is beginning to be an uptick in transactions, which I think is a good thing, because I think a lot of the no sales was kind of that hope that we're going to get that high price, and so the fact that, okay, maybe this is a place that we need to go ahead and make that transaction is, I think, a healthy sign for the market. I think regular transactions give a better understanding of what the market is, but it also means that sometimes sellers will have more realism in terms of what they're going to be able to get out of that land sale.
And Dr. Featherstone, what we're always worried about is that you'll start having more and more involuntary sales that'll create its own spiral. Are we anywhere near that being a worry?
In terms of, I don't see that in the market. I don't know whether the lenders do or not, but I don't, in terms of, I think, I think people have had difficult conversations with the bank, and it was suggested, you know, letting go this piece of land is going to help you get your balance sheet more balanced, but again, I think it's a voluntary sale, and so you're not seeing any of the bankruptcy sales or anything like that out there, and so certainly, I don't know if it's forced or not, but I think it's an indication that there is some realism that, okay, in order to continue to do what we're wanting to do, we may need to rebalance our portfolio, and land sales have been part of that.
Kathy Lascala with Angus Media. If I could continue on with a further land question. When you look at land values and availability of productive crop or grazing acres, are you seeing, I know Ken mentioned that he wasn't seeing a lot of outside sales going on, but when we look at areas where there's more competition for land because of urban sprawls, that can be a detriment to some producers continuing to farm as many acres as they would want, or to be able to buy additional acres to increase production and so forth. Are you seeing any of that taking place? Has urban sprawl had any impact on sale, land value, or producers wanting to buy additional acres for production or grazing and not able to because of that competition?
I really wouldn't have any reference on that because our footprint doesn't include an area like that. I suspect that areas like Dallas County around Des Moines, where you have quite a lot of growth in West Des Moines, that there's probably driving some farmland values there. But I'm not a good one to answer that.
Yeah, anecdotally, I wouldn't say I hear that story a lot from our officers in the field. I agree. I mean, anytime you have, those, urban area influences, they tend to have an impact on land values. Do we see a lot of farmers being forced out of their operations because of urban sprawl? Not in a significant amount that we're aware of.
Let's talk a little bit about debt levels. So we heard that somewhere between 10 and 20% of farmers have consistently lost money, despite having most of the industry having a good year last year. I'm presuming that these farmers are those that own less of their land, do a lot more renting, or maybe just in general have higher debt. What are the debt levels now compared to 5 years ago? And really the question on our mind is, what are the debt levels now compared to the beginning of the 1980s ag crisis?
I can maybe start on that. In terms of, in Kansas, over the last 4 or 5 years, we've probably on average seen the debt load increase maybe anywhere from 50 to 60 to 70,000 on average. We have seen the debt to asset ratios climb up a little bit in terms of on average with the farms that we work with, they were kind of below that 20% debt to asset ratio. They're probably now in the 23, 24% range. To me, I think that's another bright spot in terms of as we look at the economy and why I think some of these stress tests look reasonably good. If you go back probably 15, 20 years ago, and then go all the way back to the 1987, 88 levels, in Kansas, we were running debt to asset ratios in about 35%. And so, again, while 24, 25 seems high from where we had been, if you kind of look at a period of time, which kind of was 1987 all the way to 2003, 2004, we were in that 35% range. And again, that wasn't a great time in agriculture, but we were able to manage that. And so to me, that does provide provide not a totally negative picture if land values go down a little bit more, because there is some ability there. And it's a lot easier to manage a 25% debt-to-asset ratio than a 35% debt-to-asset ratio, but we're quite a bit below what the situation was for about 15, almost 2 decades there out of the farm crisis.
David Chim again. Quick question, maybe looking at it from a demographic standpoint. We look at the average age of American farmer at 58 years of age, and I'm kind of curious from the panel, what are you seeing as far as your portfolios of those younger or beginning farmers that sometimes we see? I mean, are you seeing an increase, and then how are you seeing that debt load? Are you seeing those in a kind of a group of themselves or not, or are you seeing them fare in pretty good standpoint? Again, as we see this transition generational and younger producers.
We're seeing some transition going on. I have to say that that's probably one of the more challenging areas and where we see the most stress is that sometimes that's not managed very well by farm families in terms of managing expectations. And where there's been land bought, or perhaps there was a hired man, now there's not a hired man, but we brought a son or a daughter back into the operation, and we're going to compensate them at a higher level than the hired help. So we're excited about that succession and that transition, but I think that's again, I think that's one of the more challenging areas right now, because there's a need for a lot of that to happen. But I think that again, it needs to be done in the right manner. Hopefully does that answer your question? So we make you're with FSA. We make a lot of the use of FSA guarantees. We have about $85 million with FSA guarantees. We use that a lot on for beginning operators, but we also use it a lot for carryover debt as well, for people that have sustained losses. You know, probably one of the better things that came out of the Farm Bill was the $1,750,000 now for a limit, which in today's agriculture still isn't a lot of money, but it's much better than 1.3 where it was. But the good thing about that is it's more than the guarantee itself, the piece of paper you get from the government. That's the process, and the process brings a lot to that lending decision in terms of the planning, the farm plan, the operating efficiency ratios being studied. People needing to know what their costs are, yeah. So and that's paramount for a young producer in terms of him establishing expectations for what the farm operation might return to him.
Yeah, the same thing. I think, again, it's commonality. I think with many of us serving agriculture, we know that we've got to find the solution to continue to make it attractive for young producers that are interested in starting in ag to have a successful path. The reality is many of those have some sponsor relationship, whether that's family or non-family sponsors. That's a big part of giving them a great start. 46% of our new customers that come into our organization are in that category of young beginning or small producers. So, as a farmer-owned cooperative, our board of directors have a huge emphasis. At times, almost it feels like as a manager or leader in the company, we can't satisfy their push about do more to serve young producers. But a couple things that we focus on isn't just about lending. It's about helping them be in really great business owners in understanding business acumen at a level that makes them better than their predecessor. And so we provide a cloud-based technology solution called Magnify, which really gives them a great tool to help them run a good business. Both, it includes the record-keeping component, an accrual-based picture of their financials. It gives them scenario planning. It does a lot of important business discipline that they need to learn at a young age. So we spend a lot of energy in that area. Like other lenders probably that are at this table, we do conferences and educational seminars, scholarship opportunities, just as much as we can think of. It's hard to come up with what else can we do, but I can't stress enough the importance of a good sponsor. Those that are successful tend to have a strong connection to a good mentor or sponsor.
Ed Elfman with the American Bankers Association. I'm glad you mentioned guaranteed loans. That's one of the biggest things we probably worked on in this last Farm Bill. Us and ICBA and Farm Credit all got together and agreed on something that helps farmers. One thing I would say there, I believe we're going to continue to push to get from 1.75 to at least 2.5, right? Because the realities of agriculture is it's getting bigger, takes more money, all the fun stuff that goes into that. Not to be that DC guy, and maybe we're not at that point yet, but is there anything we should be doing to be more helpful to potential things coming down the road here that we should be aware of? Does DC just need to stay out of the way, or is there some things we should be looking at now to prime the pump on where we might be a year from now, et cetera?
Well, I think that it's been decided that the crop insurance program is the safety net. And then anything that can be done to boost that up and provide a higher level of safety would be better. There's a lot of decisions going on right now about whether we're going to prevent plant or whether we're going to try to plant corn yet or put beans in or that type of thing. So, but for most people, the crop insurance that's available isn't adequate to cover all cash expense outlays on a year's basis.
Hi, Mindy McBee with Cargill Animal Nutrition. We've spent a lot of time on crop production. Are there some specific comments you can share around beef production, dairies, and just their income levels in the past few years, as well as debt to asset ratios and trends you're seeing there?
I can share a little bit out of our portfolio. I will tell you, as we were coming into 2019, we were very concerned about the expansion of production in the swine sector, and it looked like 2019 was going to be a wall that we were going to hit in terms of pricing because of the supply that was coming to the market. African swine fever showed up, and that whole industry has changed their outlook, obviously, and we have swine producers that are doing very well, and I think continuing to make sure their financial positions can withstand the outcome. But I think our view is that's going to spread into the other proteins long term. There's not a quick solution, but we're going to have a global protein supply contraction. We in the U.S. are probably in the best position, whether it's beef, swine, dairy. We're probably in the best position to satisfy that need in the global market. How that plays out in terms of trade and the trade relationships that are being redefined today is yet to be seen. But at the producer level, particularly in the swine industry, we were very fortunate. We don't have a huge dairy portfolio in our overall business. Those that we have tend to have larger production scale and market contracts with the offtake of their production, that they're coming through this period in better shape, but it's not without stress. I mean, that industry's had a pretty prolonged period of tough margins in their business, and I think we're seeing the reality of smaller producers are getting pressured pretty significantly. We've seen, not in the states we serve, but other farm credits that serve other parts of the country have had, some exits. They've had, smaller producers that have not been able to survive this period of tough margins in dairy. So just a few comments.
Dairy is probably the toughest of the animal protein sectors right now. Again, I think in terms of trade agreements, that's where resolving the trade negotiations and getting what's been proposed approved, I think there's some positives in there for the dairy sector. but the beef sector at least continues to be more profitable than forecasted. We do some forecastings of the profitability in the sector, and our livestock economists the last 2 years kind of said, well, this turned out a lot better than I expected. And so certainly trade and those aspects are going to be extremely important to all of our livestock proteins. And long term, I think it's very profitable. The FAO indicated that by 2050, the demand for livestock protein is going to double. And so the big thing, I think, is ultimately where is that going to be produced? Are we going to ship grains, or are we going to ship livestock from a trade perspective? And certainly the economics are going to drive that with regards to the volume and the ability to do that. But I think long term, I think there are some positive aspects in that livestock protein sector as economies develop across the world.
I'm going to get back to trade in a minute, because I want to definitely touch on trade disputes. But first I wanted to ask Joel about equipment sales. So in this environment of low incomes, how has that affected equipment sales? Are farmers delaying their purchases, and have you seen a change maybe in financing options to help farmers out?
So certainly peak in 2013, I think just like everyone talked about before, that's also when equipment sales peaked, but they have also been recovering. So 2019 is an improvement over 2018, pretty much across most products. Again, I'd emphasize the investment in technology, so that the advanced technology is where farmers can differentiate themselves, and we're seeing an increase in that sector. You had a second part to your question?
The second part had to do with the financing arrangements. Are they leasing more? Are they doing other things?
So through the dealer channel, again, we make products and services available to them for installment loans and for leases. I would say end of 13, we did see a shift to a little higher demand in leasing, but that's swung back the other way now. At a peak, we were at 30% of our volume came in a lease transaction. We're back down to about 20, which is a reasonably historic average.
And then getting back to trade, because I definitely want to get back to that. What are you hearing from farmers regarding trade prices and their operations? You know, I know a lot of these folks from D.C. read the Washington Post and New York Times, and there's certainly been a lot of articles written on that. We know the USDA provided about $8 billion in aid in 2018. How critical is that, and how critical would the proposed aid be in 2019?
I'll take a first shot at that. You know, I would tell you the vast majority of our producers have the same response. You know, long term, we would prefer to be in an open trade, free trade, fair trade environment. I mean, everybody wants that. As we're going through the process of renegotiating trade agreements and trying to kind of reset our position with key trading partners around the globe, I think the MFP payments have given us some shock absorbers with our producers to allow that process to happen. You know, am I excited about 50% of our farmers' net income coming from government sources? Not really, but the alternative is even worse. So, I mean, I think it's a necessary piece of the process, and many of our producers, at least, again, anecdotally in the conversations we have, are still very optimistic that this will have a long-term positive outcome for them. So that's on the whole what we hear. It's not fun right now.
No, definitely true. Let's talk a little bit about, I know we've mentioned up at the beginning, but the flooding and delayed planting and everything. I mean, do we have farmers who are going to be pushed over the edge by not getting a crop in the ground this year? Or what kind of overall effects can we expect to see this year?
Again, I don't, you know, in our footprint, we don't really have a lot of exposure or experience with this current weather event that's going on. I suspect that there is going to be some folks that are going to be substantially hamstrung by this current situation, and others that will weather through it, so to speak, with crop insurance and cash reserves and the like, and refinancings. But perhaps one of the other panelists has more thoughts on that.
Yeah, I think we're probably the same view that, you know, this event is localized, could be fairly significant. On the scale of covering 4 1/3 states on a portfolio basis, probably not as significant. But certainly if you're a producer that's either been unwilling or unable to make some adjustments over the past few years, and you're coming into a year where you're not getting planted, I think we still don't know for sure what the total dollars will be available from, you know, prevent plant combined with potentially some disaster aid. We don't know for sure what that looks like, but if you're, you know, on the edge of being able to survive and you have this scenario, it won't be good. And some of that's not just financial, some of that's just a weariness of wanting to fight the battle, for lack of better words. And I think we have some of that going on right now too. I think you mentioned it. Yeah, I think there's some concern about mental health issues and stress with some of our producers that are at the highest end of the risk spectrum, and we're concerned about that. And we're watching, obviously, in observing that and making sure that, you know, we're a conduit to give them access to, you know, resources that can help. So that's all part of it, but it's a small part of the total picture, at least in our portfolio. So we're thankful for that, and I guess we'll find out as this year plays out.
And just to add, our experience, very similar to the comments that have been made. When we look back on a national basis over a long period of time, we've had severe weather events in different parts of the country almost every year. And while it's definitely impactful this year to select farmers that are generally in this band, last year we had hurricanes that were devastating. So when we look at our overall portfolio, we don't see this as a huge anomaly.
Quick question on ethanol. So there's been some interesting announcements that have come out in the news in the past month or so, and particularly for our Iowa contingent up there. I'm just curious how that changes your conversations that you're having with your customers and your producers.
Well, I think you know, I think there were some questions under the current administration what their commitment to ethanol was and renewables, but I think it answered some of that, which was good. Ethanol represents what is basically what's brought us to this price level for corn. And so the stability of that is huge, both to the economic viability of operations and to things like land values. It's good. 15% ethanol being announced is a good thing. Now, how quickly we see that be more prevalent at the pump, I don't know. But I think that ultimately that show or commitment to renewables is a good thing. So.
Yeah, probably the thing I'd add is we're watching closely in terms of how many unplanted corn acres happen. I think the latest USDA data is telling us just under 90 million acres are likely to be planted. You know, I think the upside on corn prices are probably ahead of us, and the impact that may have in terms of margins for our ethanol producers is going to be interesting to watch. But you know, I guess it's another one. Time will tell, but certainly we expect there will be some stress in terms of the, you know, short-term corn prices and the impact that's likely to have.
Thank you. My name is Aaron Troyer. I'm with Dairy Farmers of America. Just a couple quick questions for you. Could you drill down a little bit more into balance sheet trends that you're seeing, and how much is the positive effect of profitability that you talked about earlier offset or not offset by balance sheet trends? And then also, could you speak a little bit more to what you were talking about as far as transitioning is going, and what you expect that might do to the balance sheets of the young farmers who are trying to come in and take over their family operation?
From a balance sheet perspective, one of the things that's kind of been a positive is we end up tracking the capital debt repayment capacity. And again, if you look at the low income year, which in Kansas was 2014, that got down to about 20%, basically meaning they had cash flow to cover about 20% of their principal payments. That has creeped up. As incomes have creeped up, we're probably more in the 80%, which is more of a normal range than we've previously seen. And we have seen some restructuring of the balance sheet in terms of where they've moved some of their short-term liabilities into more intermediate and long-term, maybe taking advantage of some of that equity they had on the land side and restructuring that in a way that's going to be a little bit more sustainable, such that they're able to just have more flexibility on the working capital. And so we have seen some building back of some of the working capital numbers. On average, again, there's operations that are struggling. The younger farmers, again, they tend to be the most at risk. In good times, they tend to be the most at risk in bad times, simply because they don't have that benefit of building equity. And so certainly that's a sector that in the 1980s we washed out a number of operations that were young and not unprofitable. That I think is always a concern when we're struggling economy-wide in terms of, are you washing out maybe some of the more productive individuals simply because they have the unluckiness of being at a young age and not having that equity when they entered the business.
Yeah, so a couple things that have been interesting, and again, very grateful for, is that while we've been able to do some rebalancing of balance sheets, and we had producers that chose, short amortizations, chasing the lowest interest rates when they were acquiring land, when they were having significant margins in their production, and to be able to rationalize a long-term asset with a longer amortization on that debt makes sense in this environment, particularly because they get to still lock down very, very low cost of capital. I probably 5 years ago would have bet wrongly that we'd be sitting today in a much higher rate environment. The fact is, producers have had this opportunity to do some rebalancing of balance sheets and putting themselves in a better position to manage their overall cash flow in terms of the cost of their payments, because we've had relatively low cost of capital. So that's been very beneficial to encourage producers to make some of those changes. The transition question, we recently, January of 18, so about a year and a few months into that, engaged in a collaborative relationship with Nationwide Insurance. They have a Land as Your Legacy program, which was new to us, but it really satisfied a lot of questions we were getting from producers in terms of, who should I go to help me think through these tough transitional issues. And Nationwide does it as a give back. I think many of you know their origin is a farmer-owned cooperative themselves. They have a board of directors that are very interested in supporting transition. They do that free of cost, so the time invested is really all that's involved from producers. Since we started that, we've had about 70 producers that have gone through the process. Producer still has to decide to execute, so they can get a plan that tells them insights about what they should think about doing. Producer still has to pull the trigger and execute with whatever resources they choose. So that's one thing we've been working on, but it's a growing part of the conversation. No doubt about it. Someone mentioned average age of farmers at 58. This is going to continue to be a big topic of discussion, and as a lender, I wish we had more producers willing to invest both time and some of their resources to put in place a good transition strategy. We don't see that broadly yet.
Randy Dickut, Farmers National in Omaha. Do any of you have a good handle on the amount of vendor credit that input suppliers are extending to producers, whether that's in your individual portfolios that you handle or the larger, ag industry? view? And secondly, are there any potential unexpected impacts from that?
I'd like to think we do as well as anybody at tracking vendor credit, but I will say two things about it. One is I think it's one of the biggest challengers for producers because vendor credit has become so available that it gets confusing to them. And when you're paying for next year's seed corn before you've paid for last year's seed corn, sometimes it gets lost. And now what crop is this for? You know? So I think that's that from a commercial bank standpoint. I think that that's an area that all lenders need to be focused on. There is a tremendous amount of third-party credit out there. And it's coming through the 80s. It was one of the first places people went to for a source of liquidity. So when you're loaning money, then it becomes a responsibility of the lender to make sure that your loan proceeds are being used for the purposes that they were intended. So
We have a paper actually that's coming out this summer in a publication that looks at that. And one of the things we found is roughly 30% of the farmers use at least one source of vendor credit. But if you look at the percentage of the portfolio or of the debt they have, it's running about 12-13%. And so, again, that's from our Kansas Farm Management type records where we separate that out. But certainly, there is a lot of opportunity out there. A number of producers take advantage of that. But again, it's probably 12 to 13% of the debt that they were carrying on their balance sheet.
Yeah, what I would add is where's that go from here? You know, I think we have a pretty good understanding of the current amount in the market today, but as we continue to see non-traditional, finance providers emerge in the industry, as we see further digitization of distribution of products as well as financing, I think it's kind of what happens next that's the biggest question for us. Does this grow into a very significant part of the total debt structure in agriculture or not? And so, today, I think largely most of the vendored credit that we see, at least, has pretty strong recourse and ties back to the, manufacturer or the input supply company, whichever it is. And so I think that effectively manages a lot of the credit risk. But I think over time, we'll see, because I think we're seeing emerging channels starting to show up, and how that gets bundled with product delivery, I think it's still unknown.
Good morning. Rich Kofer with the FDIC. Question I have is, what share of your producers would you consider really astute marketers? And what's the correlation between a producer who's good at marketing their crops or whatever commodity they're raising and their stability and long-term profitability? Do you see a strong correlation in that those that do a good marketing job tend to be your best customers? And for those that don't do a very good job of marketing, is that something that you try to work with them and stress the benefits of being better marketers?
Well, there's a broad range of talent or skill level in crop marketing, and everyone's always looking for magic in a bottle. So in a poor marketing year, then crop marketing seminars are always real popular. I think the key element's discipline. And having a plan, and then being disciplined to follow through on that. And so, but that's a common thing in all aspects of management. So typically, if they're good at their other levels of management, they're also good marketers, in terms of the financial side of it. So actually, we actually see oftentimes that the best marketer in the farm unit is the spouse, because they don't have to compare to what the neighbor got for their bin of corn. Or they're not as, so, but that's part of that whole discipline, I think, mentality of it, so, yeah. But ultimately, come back to a budget. Starts with a budget. What do I need for my crop? And then the discipline to market it.
Yeah, the last comments where I was gonna start, we press a lot on know your cost of production, because if you don't have that figured out, it's really tough to do the rest effectively. So, the fact that we do have, a very effective crop insurance safety net, where producers utilize that risk management tool combined with their marketing strategies, tend to produce and perform better than others. It's a differentiator. They're not gonna differentiate a lot in production. We have a lot of great producers of things, but those that invest in both the financial acumen of their business and the marketing part of their business tend to differentiate themselves. That's where they can make the biggest difference.
Time for one more question? Good.
My name's John Ulovets. I'm in bank supervision for the FDIC here in Kansas City. And I guess for those that are chattel lenders, I'm curious, a couple of you have referenced the stress and maybe some mental issues. Kind of loosely related to that is borrower fraud. And we're seeing a slight uptick in chattel fraud, whether it be cattle that disappear or grain. I'm curious if you're also seeing that in your organizations, and if so or if not, I guess regardless, what are you doing to try to keep honest people honest so that chattel fraud does not occur?
I always tell people that if my wife had chocolate chip cookies out on the counter, I'd eat them all. But if she locked them away or counted them twice a day, I probably wouldn't be as likely to eat that many. So, and I think that's probably the key, is that you need to have, you need to check. I mean, you need to go out and do inspections where that really matters. And, if you're, cash pays loans, and if the cash is coming from that bin of corn, then you better make sure it's there. And that your customer should operate in an environment where, gosh, I could sell that bin of corn and pay somebody else, or no, I can't do that because the bank may be out there. So you need to have a good process there. Now, the best part about it is, I deal with a lot of good people. They're all, my customers are the best. But in desperate times, sometimes people do the wrong things. So again, it's just a matter of having the right processes to try to avoid that.
Yeah, it's an interesting question that's got a lot of dynamics tied to it, and a lot of variables. But in today's world, where we're working more through digital channels, customers accessing their lines of credit with plastic and different ways of them interacting with us, it requires us to leverage great data capabilities and great analytical capabilities, because those are ways that you can do some things without negatively impacting the customer experience and manage the fraud risk. So we invest in a lot of that space. For larger customers, we'll do business audits. We'll do different things to make sure that, as Owen said, that the nice guy in the market's not going to satisfy your fraud compliance practices. And the part of our business that I would tell you we've had the most occurrences is in our equipment financing. So we also have a similar channel where we use dealers to finance equipment purchases. And it's another one where you have to have really robust data analytics to be able to stay on top of those transactional flows and look for outlier behaviors in those transactions. That's pretty effective, but it's still the part of our business that we'll kind of get a surprise once in a while. It just happens.
And maybe if I take that, I know your question was probably aimed more at grain and livestock, but if I take it to equipment at a dealership, so even though we have a very healthy dealer channel, we operate under the trust and verify policy.
The custom feed thing, cattle feeding, it's probably a good thing to involve the feeder as well and have them part of that verification, that they verify the ownership of the cattle. It's not maybe sufficient to have your customer drive you there and say, those are my cattle. You need somebody else to verify that those are their cattle. Those kinds of things, I think, can help. Just but again, it's an oddity, but it happens. So because for the most part, people are very honest and won't pay you. So.
Yeah, I'm going to just do a quick summary. I was jotting down some key words as the panel spoke today. And what I'm coming away with, and I'm going to turn to you all for last words, and certainly correct me if I don't have this right, but despite the fact that we're 5 years into a period of low commodity prices and lower net farm incomes, what I'm hearing from the panel from a credit quality standpoint is it's fairly optimistic. You're still able to work with borrowers. They still have lots of choices. We're not yet talking bankruptcies. Still, as always, young farmers are most at risk. And a big reason is there's some pretty significant offsets. Interest rates have been low. That helps. Government payments have been strong. Past yields have been positive over the past few years, especially last year. And off-farm income has been a big driver. I mean, we have a national unemployment rate under 4%. That helps the rural areas just as much as the metro areas. This is all positive. So we see cracks, but in general, it doesn't look like we're on the precipice of a cliff. And with that, I'll turn it to you all for whatever last words or rebuttal to that you might have.
I'll start, and I don't have a rebuttal. I found it reassuring, actually, to
That's a
hear
good word.
from my colleagues that I think our experiences are very similar.
Yeah, reassuring is a good word. Maybe better than optimistic. That's the perfect word. All right. Thank you very much. Please,